In today's high-debt, inflation-pressured economy, a quiet retirement crisis is unfolding beneath the surface of steady markets and optimistic HR brochures. This analysis argues that the 401k, born from a 1970s shift that transferred risk from corporations to workers, has turned retirement into a personal gamble shaped by fees, taxes, inflation, and market timing. By dissecting real data, hidden incentives, and long-term math, the documentary examines why traditional retirement plans increasingly fail and how workers must rethink strategy to preserve true economic freedom. Chapter 1. The Autopsy of a Promise. You're sitting in a human resources office, just starting your new job. Your manager hands you a thick stack of files and says, "Don't worry, we have a great 401k. You just deduct 5% of your salary and we'll match it with another 5%. In 30 years, you'll be a millionaire." You look at the smooth upward curve in the promotional flyer. You feel reassured. You think you have a plan. But here's the truth no one told you. You've just taken on an unpaid side job, becoming your own hedge fund manager. The great shift in responsibility. To understand why the 401k system is such a risky gamble, we have to go back to the 1970s. Before that, the world operated on a defined benefit pension system. If you worked for Ford or IBM for 30 years, the company was responsible for paying you a fixed pension until you died. Market risk, inflation risk, the risk of living a long life, all rested on the corporation's shoulders. But in 1978, a loophole in US tax law, Section 401k changed everything. Corporations realized a spectacular trick. They could shift the entire trillion-dollar financial burden onto their employees. Suddenly, the burden of securing your future was no longer Ford's or IBM's, it was yours. If the market crashed just before you retired, it was your fault for choosing the wrong portfolio. If inflation devoured the purchasing power of the dollar, that was your risk. The 401k system transformed retirement from a social benefit into a personal financial product. The numbers speak for themselves, and they're screaming. This system is designed on a perfect assumption. Everyone has iron discipline, deep financial knowledge, and the market will consistently grow 7 to 8% annually. But what's the reality? According to Vanguard's report, How America Saves 2024, the average account balance is approximately $134,000. But the median balance, the more realistic figure for most people, is only $35,000. Let's do a quick forensic calculation. If you're 65 and have $35,000 in your account with a 4% annual withdrawal rule, you'll have $1,400 a year. That's not retirement. That's a social catastrophe waiting to explode. Chapter 2. The hidden trap. Why does the system want you to believe it? There's a reason why investment banks and fund managers love 401ks so much. And the trap is forced liquidity. Every month, millions of workers automatically draw from their salaries and pour the money into the stock market through 401k. This is a huge, steady, and blind source of demand. Wall Street doesn't need to convince you to buy stocks. The system does it automatically. This creates an artificial floor for stock prices. When you can't withdraw your money before age 59.5 without a 10% penalty plus taxes, you're a financial hostage. Your money is locked up, creating regular management fees for the funds, even as your account is losing value. Most people never look at the expense ratio in their 401k portfolio. They think 1% or 1.5% is a small number. Let the forensics tell you. If you invest $100,000 for 30 years with a 7% return and a 1% fee, you'll end up with around $574,000. But if the fee is only 0.2% like cheap index funds, you'll have $708,000. Where does that $134,000 difference go? It goes straight into the fund manager's pockets. You bear 100% of the risk, you invest 100% of the capital, but you share nearly 30–40% of the final profit with an entity that simply sits back and collects fees. The system encourages you to set it up and forget it. This is an incredibly subtle psychological trap. When you don't see the cash outflow each month because it's deducted directly from your salary, you don't feel the pain. You lose your sensitivity to the value of money. This lack of attention is where lifestyle creep begins to flourish. You think you're saving because you see your 401k account growing, but in reality, the real purchasing power of that money is being eroded by future inflation and taxes, things that the HR flyer never mentioned. Chapter 3, the cruel math, taxes, inflation, and the silent thief. If chapters 1 and 2 dissected the structure, chapter 3 is where we look at the bleeding wounds in your wallet. There are 3 thieves waiting for you at the retirement finish line, and they are deferred taxes, real inflation, and sequential risk. The biggest benefit of a 401k that everyone praises is you get a tax deduction now. Sounds great, right? But let's pause for a moment. In essence, a traditional 401k is not a tax-free tool. It's a deferred tax liability. The government is telling you, don't pay me taxes now at 15–20%. Take that money and invest it. Risk losing it all in the stock market. And 30 years from now, when you're old and no longer able to earn money, I'll come back to collect my share. The trap is this. You're betting that tax rates will be lower in 30 years than they are now. With a country in debt exceeding $38 trillion, do you really believe the government will cut taxes? Financial forensics shows the opposite. When the social welfare system runs out, those huge 401k accounts are a gold mine for the government to exploit through increased income taxes. You're accumulating a huge amount of money only to find yourself working for the Internal Revenue Service without pay in the future. We often hear about the target inflation rate of 2%. Official inflation figures, CPI, often ignore or lightly adjust for the most essential costs for retirees, healthcare and housing. Data from Fidelity Retiree Healthcare Cost Estimate shows that a couple retiring at age 65 inches, 2024 will need approximately $330,000 just to cover healthcare costs after retirement. That's after taxes. If you only have $134,000, the average of 401k, you won't even have enough money to cover your medication bills, let alone food or travel. The harsh reality here is, if your savings account grows by 7%, but healthcare costs increase by 8%, you're actually getting poorer every day, even though the numbers on your phone screen keep rising. Chapter 4, the protection model, building your own retirement fortress. So if the 401k is a risky gamble, what should we do? Don't get me wrong, I'm not telling you to withdraw all your money and hide it under the mattress. I'm telling you to change your approach. We need a multi-layered protection model. Layer 1, tax diversification. Don't put all your eggs in the traditional 401k basket. If your company has a Roth 401k option, take it extremely seriously. With Roth, you pay taxes today when tax rates are low and are completely tax-free when you withdraw. This is how you lock in your tax obligations and chase that IRS partner out of your future pockets. Layer 2, maximize but don't depend, the match trap. My advice, only contribute enough to your 401k to get the portion your company contributes, match. That's the only free money left. Anything beyond that amount, you should ask yourself, why should I lock my money into a system with limited choices and hidden fees when I can open a personal investment account, IRA or brokerage, with extremely low costs and absolute freedom? Level 3, hard assets. A true retirement turret isn't built on just digital numbers on a Wall Street ticker. It needs to be anchored by assets with real use value. Cash flow real estate, something that provides you with monthly income, regardless of whether the S&P 500 is green or red. Income generating skills. The best investment is your ability to earn money. If you have a skill the world still needs when you're 65, you'll never have to worry about how long a bear market lasts. Chapter 5, the escape, the story of two futures. Alex versus Jordan. Alex, the system follower. Alex contributed the maximum amount to a traditional 401k for 30 years. He didn't check management fees, didn't care about taxes. By age 65, Alex had $1 million. He excitedly pulled it out to travel, but discovered 25% was gone due to income tax. 10% was swallowed up by medical inflation. And a market crash in his first year of retirement wiped out 20% of his assets. Alex was forced back to part-time work at age 67. Jordan. The independent strategist Jordan only took his portion of the company's match fund, pouring the rest into Roth IRAs and buying ultra-low-fee index funds $0.03%. He also used some of the capital to buy a small rental apartment. When Jordan retires, even though his account balance might be lower than Alex's on paper, every dollar Jordan withdraws is 100% his. The cash flow from his rental apartment covers his basic needs. Jordan doesn't need a perpetually green market to enjoy a good dinner. The 401k system may exist, but it won't exist to serve you. It exists to serve the operations of Wall Street and the government. The question isn't whether the system will survive, but whether your retirement plan will survive if you continue to play by their rules. Retirement isn't a number. Retirement is freedom of time. And that freedom begins with stopping gambling and starting to calculate.